All right, in this lesson, we are going to give you an introduction to depreciation. Now, as we do this, I'm going to kind of explain what depreciation is. It is another section that we're going to go to later on in this course where we'll dive deep in it. So it's not that you need to understand how we calculate depreciation, but you should know what depreciation is and then how do we book that entry. Now, depreciation, from what you need to know right now, is a form of deferred expenses. So we buy a long-term asset up front, and then we allocate its cost over a period of time. We call that the useful life of the asset. So depreciation usually is reserved for those long-term assets that we believe is going to provide us future benefits for longer than 1 year or the operating cycle of an organization. And it has usually a big upfront cost that we're going to have to spread over a period of time. So that's what we're talking about here with depreciation. So let's get started here with helping you understand what depreciation is from a deferred expense standpoint. Now, depreciation is a cost allocation process to systematically allocate the cost of a long-term tangible asset over its useful life. Now, depreciation is a form of deferred expenses. We incur a cost for a long-term expense on day one because we have a huge cash outflow, but we get the benefits, meaning the revenue benefits, indirectly or directly, from the long-term asset over time. So what we're saying is, when we buy a delivery truck, for instance, we might have to spend $70,000 for it today, but it's going to give us revenues over 10 years. And so we are going to benefit from this asset over 10 years. And if you know anything about the matching principle says that we match the expense to the revenue. Well, if the revenue is going to, if the truck is going to generate revenue over 10 years, then we need to allocate the cost, the $70,000, over 10 years as well. So that's what this is basically saying, is we have to allocate that cost over the period of time in which we are reaping the benefits from it. Okay. So just like we have supplies and supplies expense, we have assets and depreciation expense. So when we think about, what's that expense transaction going to look like, we don't debit the vehicle expense. We will debit something called depreciation expense. This is the first time you're probably hearing about it, but depreciation expense represents the expense for the cost allocation of long-term assets, which is what we're talking about in this section. So you'll need to know depreciation expense from an entry standpoint. Now, however, one thing that is not like supplies and supplies expense, we never reduce an assets account balance. Instead, we will use an account called accumulated depreciation. So what do we mean there? Well, typically in the last lesson, we showed you that when supplies are used, we would debit supplies expense and credit supplies. In this section, or this lesson here, we're telling you that when we take the cost of a vehicle and we allocate it over a number of periods of time, we will debit depreciation expense, but we're not going to credit the asset. So we're not going to directly credit the asset. Instead, we're going to credit something called an accumulated depreciation. Now, a lot of people ask, why is that? Well, we want to preserve the cost of an asset on our balance sheet. If we credit the asset, then the asset's going to be shown on our balance sheet at net, which is what's left to allocate, but it's not going to show us what we purchased it for because of that credit entry. So instead of doing that, we credit something called accumulated depreciation. And I'll show you what that looks like when we do an example here. Now, what is accumulated depreciation? The accumulated depreciation account is an accumulation of all depreciation taken since the asset was first acquired. So accumulated depreciation is the accumulation of all the depreciation taken since the asset was first acquired. What that really means is that, let's say we started depreciating an asset over the past 5 years, and every year we depreciated $1,000. So we allocated $1,000 to every single year. So what would the accumulated depreciation account be? Well, 5 years at $1,000 a year, the accumulated depreciation account for that asset would have been $5,000. The accumulation of all the depreciation. So year 1, we took a depreciation of 1,000. Year 2 is another 1,000. Year 3 is another 1,000, and so on and so on. So that was $5,000. So the accumulated depreciation would stand at $5,000. The accumulation of all the depreciation over its useful life, or when the asset was acquired. All right, accumulated depreciation is a contra asset. That's a new term for you. It is a contra asset account, and it does belong to the asset column. So you're going to see that it doesn't really act like an asset because it's not, but it reverses kind of what the asset does. It works with a particular long-term asset to get the asset's book value. So what do we mean? Well, let me give you an example of what it looks like. So for instance, let's say we buy an equipment for $45,000 over the past couple of years. We've depreciated it X, Y, and Z amount. And so right now, the accumulated depreciation account for that asset is standing at $9,000. So the way that we would look at that asset on our balance sheet looks exactly like I have it on the screen. The equipment would show on the balance sheet at $45,000. Right below it would be the accumulated depreciation. So it's still with the asset being the equipment. We have got the accumulated depreciation of $9,000, which would give us a net equipment of $36,000. That $36,000 represents the book value. What is the book value? The book value is what the book says that asset is valued at. Now, that's not the same as fair value. Fair value is what you could get for that asset in an open market. We're not saying that that equipment is worth $36,000 in the open market. We're saying based on a cost allocation approach using depreciation in our books, this asset is worth $36,000. Whether it is or it isn't, it's worth $36,000 in our books. Now, it could be worth $40,000 in the market. It could be worth $20,000 in the market. That's okay. We really don't care about it until we sell it. But whatever we put on our balance sheet, whatever it shows us, that is our book value, what it's worth to us in our books, okay? So that's kind of how the balance sheet would look like. You would have the equipment right underneath the accumulated depreciation, which will net out what that asset is actually worth in our books. In this case, it's worth in our books for $36,000, not $45,000. But we're going to show investors that the equipment cost us $45,000. We've already depreciated $9,000. So in our books, that asset is worth $36,000. So let's take a look of a visual representation of depreciation. So let's assume that you purchased a car for $25,000 and it's expected to last for 5 years. Now, if this is our timeline of 5 years, on a cash basis, you could say that we incurred a $25,000 cost on year 1, but then if you did that, you would also say that in year 2, 3, 4, and 5, that vehicle's costing you $0. And what we know about this is that we want to make sure that we are not violating the matching principle and saying that we're going to match the cost to the revenue. Well, if we did it this way, so if we booked a vehicle expense for $25,000, credit cash for $25,000, this would be incorrect because we are actually getting revenues of this vehicle over the next 5 years. So this doesn't match the cost with the use of the asset during the revenue period. So what do we need to do? We need to do depreciation. So what do we do? Well, under the accrual basis, what we're doing is we are going to take that $25,000 and spread it to every year in which we incur revenues, or we are expected to incur revenues. So in this case, instead of just $25,000 of expense in year 1, we would have $5,000 of an expense in year 1. $5,000 for each of the years represented by the usefulness of this vehicle. So in this case, we expect that this vehicle to be useful over 5 years. So $25,000 divided by 5 gets us $5,000 a year. Now, this way matches the cost with the use of the asset, the revenue period. So the two words that you should know is the expense versus cost. Cost is kind of the cash outlay. Well, we incurred a $25,000 cost, cash outlay, right? But that's not how much we incurred in expenses in year one. How much did we incur? Well, if this is supposed to last us for 5 years, it's like we're paying $5,000 a year to use the car. At the end of the 5 years, we sell it or we dispose of it and we no longer have it. And if we dispose of it and we don't get anything for it, it's like we paid $5,000 a year to use that vehicle for our business. And that's the time frame in which we incurred revenues from it. So that's what we're trying to do with depreciation. So let's go through an example here just to help you understand. On April 1st, 20X1, Walnut Creek purchased an equipment costing $12,000. By the end of the month, $350 of depreciation has been accumulated and must be adjusted for the month. So we need to do the adjusting entry. The adjusting entry, well, the cash was already paid. So the cash was already paid, and it was, just for your information, it was debit equipment for $12,000, credit cash for $12,000. Now we got to do the adjusting entry, the depreciation. So the way that we do this is we have to debit an expense. Well, what expense did we learn about in this section? Or this lesson, we learned depreciation expense. So if it's an expense and it's increasing, we're going to debit the expense. So we're going to debit depreciation expense for $350. And then the question is, what are we going to credit? Well, we could credit the asset, but we learned in this lesson that we can't credit the asset. So what do we credit? We credit the accumulated depreciation account. So we credit accumulated depreciation for the same amount, $350. Why don't we credit cash? Because the cash was already paid. When did we pay it? When we first acquired the asset. So we don't want to pay again, so we are not going to credit cash. In this case, we're going to credit accumulated depreciation, which is like what we do with supplies. We would credit supplies, the prepaid account. This would be the prepaid account, kind of. All right, so if we look at the T accounts, how does this affect the T accounts? Well, if you notice here, we had a debit depreciation expense for $350. It's on the left side, so we'll put it on the left side of the depreciation expense. Accumulated depreciation was a credit, goes on the right side, so it goes on the right side of the T, so that's what we have there. Now let's go ahead and add up all of the balances. So equipment, $12,000 minus 0 is $12,000. Depreciation expense, $350 minus 0 is $350. And then accumulated depreciation, the bigger minus the smaller. Bigger is on $350 on the right side, minus 0 on the left side gives us $350. And so that's what it looks like. Now notice here, we didn't decrease equipment. So we leave the asset at its cost value, in this case, $12,000. But notice when we do the journal entries, we're going to increase the expense, in this case, depreciation expense, and we're going to increase the accumulated depreciation. The accumulated depreciation is going to offset the equipment. So on the balance sheet, it would show equipment at $12,000. Right underneath it, it's going to show accumulated depreciation for $350 and a net equipment for $11,650. So this asset is now worth $11,650 after its first month of use. Is that what it's worth in the market? No, it's what it's worth in our books. Okay. Now, some notes about depreciation. We will discuss depreciation in another section. Depreciation will usually be given to you until the depreciation section. So you're not trying to figure out depreciation per se. We're going to give it to you until we get to that section, which is soon. So it's not like you're going to go that far without learning it. But you generally got an idea of how we calculate it out, at least from a basic standpoint. $25,000, 5 years, $5,000. So kind of give you a preview of what you're going to see later on. Okay, so that is a look at depreciation. Again, it's not a tough thing. It's just like a deferred expense. The cost of the asset goes out on day one, and then we're going to allocate the cost over its useful life, just like we would allocate the cost of a prepaid over the period in which we incur the actual expense. When do we incur the actual expense? Over time in which we receive revenues, or in which we've earned revenues. So I hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below, and I'll respond to you on what you got out of this video. So hope you enjoyed this video, and we will see you in the next lesson.